Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Thanks for being back with us and for tuning in today to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom K. Wilson, your host for the 2 p.m. Wednesday edition of Real Estate 360. It comes to you daily, Monday through Friday at 3 p.m., and also on Wednesdays and Thursdays at 2 p.m., along with my co-hosts Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch our podcast on RE360radio.com, and on my programs, you can catch them on TomWilsonProperties.com, or on iTunes, or on YouTube. So if you go to TomWilsonProperties.com, you'll see a list of all the programs and the subjects and topics and the guests that we've had, and you can listen to that any one of those programs. We today are going to answer your questions. You ask a lot of good questions about real estate investing, and today is your show. Then we're going to go through rapid fire and cover a lot of the questions that you ask and see if we can answer them for you. In addition to the podcast, you can go on TomWilsonProperties.com, our Wilson Investment Properties website, and you can sign up for a weekly newsletter on the economics of real estate, written by an economist weekly. You get a short 2-minute read that brings you up to date with what's going on in the world of economics and real estate and how it applies. Very good way to keep up to date. It's hard with all of our world of data and information to go read all the sources out there and try to put it together, and that does a nice job for you. You can also request a report on how to select the best metro and product. You can also request a consultation session with us, and we'd be glad to talk to you about your either existing portfolio or the potential of having one, and ask your questions, and we'll help give you suggestions on what we would do if we were in your position. And as always, keep your good questions coming in and suggestions on topics and guests that you would like to have on the program. So we've had the great pleasure the last couple of summers of having a intern with us during the summer, and I'd have to say that the objective has been to try to give them some experience that they would not get in school. But I think we've been the on the winning side of the equation, and each time we've learned an awful lot and gained a lot from them. And this year it was we had with us Daniel Kleinsmith, and Daniel, welcome to the program, and tell the listeners a little bit about what you're doing in school and where you're going.
Well, thanks for having me, Tom. This summer's been awesome. I've learned more than any class could possibly teach me. I'm a third-year econ major down at Cal Poly focusing in finance. And the one thing I've learned in finance is that we focus on Wall Street. We learn about stocks, bonds, mutual funds, and the like. But we often forget there's other ways to invest. And one of those ways is real estate. And so I've learned this summer that real estate provides another way to diversify your portfolio, where, being an econ major at Cal Poly, we sit there and think about stocks and bonds like, hey, what stock should we buy? Let's go buy Apple. But no one ever thinks about, hey, let's go buy a house. And so it's another form of investing that people often leave out. And the other thing that I learned, which I didn't expect, is that it takes a lot more to make a property cash flowing than meets the eye. So you have your property management, you have loans, you have rehabs, all of which, if you do wrong, can kill the cash flow. And so it takes a lot to find the right property managers, the right loans, the right rehab crew. And the great thing about having a turnkey property is that it minimizes the risks of you trying to find these people and finding the wrong ones. So I've learned what it takes to make a house cash flowing and what it takes to make a house not cash flowing.
Just as important, huh?
Exactly, because you don't want to go buy that 6-bedroom, 5-bath, beautiful home, and you get in there and find out it won't rent for what you need it to. You also don't want to go buy that 1-bedroom, 1-bath home that no one wants to live in. And so I think Tom has found the sweet spot of the 3 to 4-bedroom, 2-bath houses where they're nice houses, you'd love to live in them, but they cash flow better than, say, your 7-bedroom Beverly Hills mansion. So
or in other cities, right? Yeah.
Exactly. Yeah. And when it comes down to it, you need to find the right metro. I mean, it's always tough to figure out, first off, out of state, if you're not from the area, to learn about it. And then to find a metro where houses will cash flow. And then, I mean, you have to have good job growth. You have to have good rental markets. You have to have good cash flow. Bruce Norris, who is a California market timer, has always argued that you have to have good inward migration for an economy to do well. And what causes good inward migration is job growth. And so we have been investing in the Dallas-Fort Worth market largely because it's one of the best economies for any metro in the United States ever right now. I mean, it's having fantastic job growth, fantastic population growth, which all leads to a great rental market. So, I mean, I've had a great summer with Tom. He's taught me more than any class I've taken at Cal Poly has. And let's go to him.
Thank you, Daniel. It's been great having you. It's just really exciting to see how much information that you've absorbed and how quickly you're able to come up with answers and things that have assisted us greatly. We've given Daniel assignment in part during the summer of doing a little deeper research than we do on a kind of weekly basis on some of these markets, so that we can have a really good handle on how the economy and population demographics and migrations and so forth are happening. And if you'd like some of that information on the certainly the major Texas cities of Dallas and Houston and San Antonio and Austin, let us know. We'd be glad to share that with you. He did quite a bit of work and wrote some really nice reports indeed. What interested you, Daniel, in doing an internship with a company which I imagine you never heard of the concept before of a turnkey provider of investment properties? What gave you that interest? Was it our intern last year, Jack?
So I am good friends with the intern they had previously, but what really made me want to go into real estate is that down at Cal Poly, we learn a ton about stocks, bonds, other types of what you call like Wall Street investing.
And it's certainly a much more practical school about teaching you things than the average school is.
And
right?
I mean, I've learned a ton there, but one thing they completely ignore is real estate. So coming in and spending a summer learning about real estate investing, I get a handle on different types of investments that I wouldn't have down at school.
But what kind of turned you on to that? What made you interested in learning about real estate investing?
So Jack Murphy, who was their intern last year, worked for them, and he came down, visited me down at school, and said, "Hey, I had this great internship. I learned more than I've ever learned down at Southern Methodist University, SMU." And he said, "Hey, Daniel, you're a really smart guy. I think you'd like this." I'm like, "Hey, I'm a kind of smart guy. I like learning." And I figured real estate would be a great thing to get my foot in the door because I won't have a chance to do that down at school. So Jack said, "You'll love it. Tom's a great guy." I'm like, "Cool, I'll meet him." We ended up getting coffee, talking for a little bit, and came work for him for the summer.
And you know what your next assignment is, right? To find our intern for next year,
exactly.
Right?
I know. The pressure's a little high right now, so hopefully we can find someone just as good as me. Which, I mean, there's smart people out there. I think we'll find someone good.
Oh, it's been wonderful having you. You've been great. Daniel, let's give the listeners some little bit of information about some specifics of real estate. Let's walk down some of the questions that you've been receiving, and let's see if we can get some answers for folks about that are frequently asked about investing in real estate.
Sure. So Michael Lee from Cupertino asks, "I am a first-time investor. What should I look for in businesses that sell investment properties?"
Well, that's certainly a fair question. In the past, it was quite popular for people to just go out and find their own property or find any agent and say, "I want a rental property." And when it's nearby, you probably have an association or relationship with an agent, and they say, "Oh, sure, I can find you something." Now, nowadays, it's gotten a lot more sophisticated than that. And because there are more variations from one region to another. It's become more popular to invest out of state because the rent ratios, which drives the ability to cash flow, vary a lot. So I think because it's a lot more sophisticated, a lot more moving parts than people realize, it's really valuable to, like you do for any other important decisions, you go find a professional who does that full time, who's spent a lot of time being educated in that area, and can get you the best results. So what's popularly referred to today as a turnkey provider, like Wilson Investment Properties, can already has done the heavy lifting and the hard work and the heavy research. They're large enough that they have enough volume that they can attract market research information. They can attract the best property managers, insurance agents who focus primarily on investors, lenders who focus mostly on lenders, on investment. And those folks, why reinvent the wheel? Go find someone who's already an expert in that area and utilize them, because you wind up not spending any more than you would if you tried to do it yourself, because they have an economy of scale. And two, you greatly reduce your risk by being with a high quality provider who's able to sift through all the different properties and options out there and select the best ones.
So Kevin Young from Orange County asks, is finding successful properties all about the numbers, or is there some guesswork involved?
I would say, unfortunately, a lot of people use some guesswork and they use some emotion. And being a engineer by education and being in the high-tech world here in Silicon Valley for 46 years, I'm just focused on an analytical approach to making decisions and try to keep the emotion out of it. And I find it's a lot easier. With your own home, it's almost impossible to keep some emotion out of it. But with an investment property, it should be strictly analytical. But there's one other factor, and that is the people. So, you got to have people in your team or on your turnkey provider's team that you feel comfortable with, that are very customer service oriented, and just have had a lot of success. Okay, we have time for one more, I think.
So Jeremy Rudolph from Sydney, Australia asks, do you need to have previous real estate experience to be a successful investor?
Certainly not, but you need to have a team that has a lot of real estate experience. So the same as you may have a stockbroker that you really trust who's been successful, and you basically are trusting them. I think in real estate, you just got to make sure that you have a team of people who are experts in that area. So we'll be back with more questions here in just a couple of minutes. This is Tom K. Wilson on Real Estate 360, AM 1220, KDOW, the Wall Street Business Network. Stay with us, and we'll be back with more frequently asked questions from real estate investors.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We have in studio with us today Daniel Kleinsmith, who's been with us for 3 months as an intern from Cal Poly, majoring in economics. He's learned a wealth of information in 3 months. He's been with us, and we've learned a lot from him, and he's done a great job for us and a lot of market research and so forth. So he's assisting us he's collected a lot of the questions that have come in from investors, and we're going through them quickly, trying to give you some answers to a lot of the things that people ask. Daniel, what's next?
So Michael Catwan from Los Angeles asks, should I buy houses in one market or many?
Great question. I've recommended to many people that they start investing in houses, and they come back to me a couple years later and say, Tom, I've got 10 houses now. I say, great. Where did you buy them? And they'll say, well, there was one in Orlando, and there was 2 in Miami, and there was 1 in Phoenix, and 2 in Dallas, and And they go down the list, and oh my gosh, that's a management nightmare. So you don't want to do that. It's there's a certain amount of value in having not too many property managers to interface with. I don't see a problem with two, but start with one. Start with one, and then if you feel like you want to get some diversity, go with another. And don't spread it out too much. Go pick something that makes sense. If you're shooting at random, not sure what's the right place to go, then that might seem like a good approach. But if you do your homework and figure out what's the best metro to invest in, or say the top three, then pick one to start with and then go to another one.
Kayla Dueling from Irvine asks, how does real estate compare to other investments such as mutual funds, IRAs, stocks, etc.?
The history shows that actually, regardless of which kind of real estate, commercial, residential, single family that you invest in, over a long period of time, it has traditionally outperformed stocks and bonds. It's not as passive, but it's very passive to say I want to sell this stock that's at 50% of but it may be painful. Whereas I think the downside risks are less with real estate, and I'd say, just looking at this past crash, one might say, well, I don't know if you can say that. Well, actually, as it turned out, the the stock market crashed a great deal more than the real estate market did. And if you chose the right metro, like DFW, it only went down by 7.7%. So if you choose the right place, then on the average, they've outperformed other forms of investment.
Priya Tanvi from Berkeley asks, should I buy the most expensive house my budget allows?
I'd say no, not the most expensive house. You should buy the most amount of assets that you can buy, and usually that will be multiple properties. You don't want to buy an expensive house because generally the rent ratio will not support cash flow. So as houses go up in value, whether it's in time or across different metros, you will find that the rent ratio does not appreciate as rapidly as the house price does. So if you start to get expensive, and by expensive we let's just say as a rule of thumb, you get up toward a $200,000 house, no matter where it is, it gets very difficult to get enough rent. Generally, the rule of thumb is you want 1% per month rent of the value of the house with a 20 or 25% down loan in order for it to cash flow. So a $200,000 house has to get $2,000. And let's say a $500,000 house, almost impossible anywhere in the country to get $5,000 rent. So usually the sweet spot in most cities are somewhere in the, say, $80,000 to $150,000 range. So what you want to do, instead of buying one $250,000 house, you want to buy two $125,000 houses.
Palesh Partha from Santa Cruz asks, what factors do you look at when comparing rental properties?
Of course, that could be a whole show in itself. In fact, it has been in the past. But I would say the first thing you want to pick the location. Location's based upon what gives a great rent ratio. It also, you want to pick a place that has inward migration. The migration is usually drawn by jobs, so that's very important. And then when you're looking at the properties, you don't want ones that are so expensive that it's hard to get the rent ratio or difficult to find enough people who can pay that money for it. And you don't want to get properties that are so cheap that you get poor demographics, get high turnover, bad quality tenants that tear the place up. So we're going through common questions and frequently asked questions by our investors that Daniel Kleinsmith has accumulated for us, and we're walking through today. Come stay with us. We have a lot more questions and answers for you. We'll be back in just a moment here on AM 1220 KDOW, the Wall Street Business Network, on Real Estate 360's program here on Wednesday on real estate investing. Stay with us.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thanks for staying with us. We're now today answering questions for callers and folks that have emailed and sent in their questions. Daniel Kleinsmith, student, economics student at Cal Poly, is assisting us with that. Daniel, what's the next question?
So Ty Krieger from Calabasas asks, is cash flow king or other metrics such as cap rates or cash-on-cash return more important?
Well, actually, all three of those are essentially the same thing. I would say cash flow in general is indeed the most important thing, and not that something would cash flow in the future, but I would only buy assets that cash flow now. And I'd say what you should not do is speculate or buy just hoping that you'll get appreciation if it does not cash flow now.
Peyton Vanessa from Almaden asks, should I invest in properties close to where I live, or should I consider out-of-state properties?
Historically, buying near where you live was very popular because it was more intuitive, and before this business got as sophisticated and as many variations there were across the country. Back in 1970, when I bought my first property, it was $30,000 in Silicon Valley and rented for $300, had the 1% rent ratio. But as time went on, prices at coastal cities shot up higher, and the rent ratios don't make them cash flow very well anymore. So now I would say, just like if you buy a stock, you want to buy one that has the best return on investment, not one that you can drive to. And I think the analogy applies to real estate. So again, when you go and invest in a company, you want to make sure it's managed well. Same thing with real estate. As long as it's managed well, you want to go get the one that thinks is going to get the most return on investment. And the best ones I find are in Texas, and Dallas is my number one choice there. So, but make sure you have a good property manager. Make sure you have a turnkey provider who has already chosen a great property manager for you.
Elena White from Napa asks, if I invest out of state, should I use a lender in that state?
It depends on the state. In Texas, the lender laws are a lot tighter, and so therefore we found people that try to use a lender that's, say, in California or other states have a great deal of difficulty closing it. So certainly for Texas, I would say to close it, to use a lender that's within that state. Other states, I think it varies by state. And if you use a broker in your state, at least have them hand the package off to someone in that state, and I think you'll find they typically will get through faster.
Kendall White from Bainbridge, Australia asks, does having a higher credit score decrease my interest rates on investment properties?
It does, not by a whole lot, but indeed, the higher the score, the better. If you have a 720 or higher, you're getting pretty close to your best rate, which today is about 4 3/4 for investor, which is still amazing. When I started expanding in '99, it was 8.5%, and I couldn't get enough of them. They were just terrific.
So Nathan Nguyen from Palo Alto asks, is it better to buy all cash or use financing?
Depends on your objective. If you want the maximum cash flow and return on your down payment long term, then I suggest leveraging or using some loan money. Now, you can adjust your level of risk. Of course, the higher loan you get, the higher downside risk that you have. So if you want to be very conservative, I would say you do a 65% loan instead of an 80% loan. If you do all cash, you certainly will get, in the purchase, you'll get the most cash out per month, but you'll get the lowest percent return on your investment. So be back with us in just a moment, and we'll go through some more good questions from our listeners. This is Tom Wilson on Real Estate 360, AM 1220 KDOW, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
With us, we got some great questions here that Daniel Kleinsmith, their intern and student from Cal Poly in economics, has gathered for us. Daniel, what's the next question from our listeners?
Thanks, Tom. Michelle Wong from Ontario, Canada asks, should I manage the properties I own?
I recommend not managing your own and separate the concept of investing and management from each other. That's a mistake I made early on. I kind of thought you had to do both. I forgot you could farm out management. Focus on the investment part. Let the experts in management manage your properties.
Gregory Sharp from Santa Rosa asks, what qualities should I look for in an investment property management firm?
Well, you certainly want to have a firm, I think, that has a licensed agent in it, or that they are licensed. You want to have one that has enough quantity of properties, that they've got enough critical mass to have the staff to support you if one or two are out. You want them to have a good track record. You want to see the stats on occupancy and make sure they're at least as good or better than what the averages are for that area. You want to find out if they are able to do rehabs economically, that they have good reports, financial reports each month, and that they communicate well. So get some references once you've narrowed it down, or use a turnkey provider's input.
Kim Young from Calabasas asks, how do Californian laws and Texas laws differ for real estate investors?
They do. Unfortunately, I love living in California, but our laws have become more and more restrictive to do business here, and that's landlording and renters are no different. I like Texas because they don't have any rental regulations, rent control. They are more business friendly, so businesses like moving there to which gives jobs to attract people, but things, they protect the landlord. If a tenant needs to be evicted, it can be stretched out 5 months here in California, and in Texas, pretty much 21 days is it. They will, even the sheriff will show up and help your property manager evict the person, and even set all of their contents on the curb. Can you imagine? We'd all go to jail here in California, but no, they're very landlord friendly. They have this strange concept. They think if a tenant doesn't pay rent, they ought to leave.
Who would have guessed? So Robert Lee from Santa Barbara asks, does Texas really have the same booming economy California, and particularly the Bay Area, has?
Indeed. For those of us that are fortunate enough to live here in the Bay Area, we're seeing a good boom again. Although it wasn't that long ago, people thought we were dead economically. When I moved here in 1969, we were having a recession, and people thought Silicon Valley was over then, but it keeps building on the fundamentals before it. California as a whole still is not fully recovered. We're seeing a unique thing here in the Bay Area. I would say Texas as a whole has pretty well recovered, certainly the economic triangle of Houston, San Antonio, and Dallas. And I haven't been to San Antonio recently, but I've been in Houston, been in Dallas several times this year. And it is a booming economy. Their companies are still moving there. There are cranes everywhere. Infrastructure is expanding. They're even doing a $1.5 billion expansion on the airport in 2008, when most thought the world was coming to an end. So they're a very optimistic bunch down there, and they really know how to promote business expansion.
Michael Lin from Long Beach mentions that in the Silicon Valley, San Francisco, and parts of LA, a modest house will sell for nearly $1 million. What would a comparable house in Texas cost?
Comparable house in Texas is probably about $200,000 or a little less in Dallas or Houston. So you find about a 4-to-1 ratio for a starter home. The difference is that the home is usually better quality and newer there in Texas, because they had some of their boom and expansion later than we did, and so you'll find that the most of the homes, large percentage of the homes, are built in the 80s or newer. They were all mostly brick homes, and we will find that, say, a medium price house in Silicon Valley now is $800,000. You can buy that house for $120,000 in Dallas Fort Worth. The house here will rent for $2,500, maybe $3,000. Down there, those say that $800,000 will buy you 7 or 8 houses, and you'll bring in $8,000 a month rent. So the houses are better, and they are a lot cheaper there than they are here.
Hector Pitter from San Diego asks, can you count on appreciation in Texas?
Well, I think you can't count on appreciation anywhere, but the best thing we have to go on usually is, along with some economic projections, is to look at history. And if you look at the last, I have clients sometimes that say, Tom, I like everything I see about Wilson Investment Properties and the products that you have, but I don't want to, and I believe in cash flow, but I don't want to give up appreciation. Well, that's a misnomer. Last 2 decades before the crash, Dallas and Texas appreciated about 5% per year. So it doesn't sound like a lot, but if you're leveraged 4 or 5 to 1, that's really 20 or 25% return on your down payment along with the cash flow. So, and if you do a tax-free exchange in the future, then you're protected. You don't pay tax on that. So it's really it's really quite a good appreciation when you look at it from that standpoint.
Peter True from Mountain View asks, how are the Dallas Bay Area economies different or similar?
The similar part is that Dallas and San Francisco are the financial capitals for their region, and the adjoining kind of sister city or stepchild from the past were predominantly agriculture, like San Jose and Fort Worth. About the same size, almost identical in geographical size, the Bay Area and DFW, and the population's the same, 6.5 million. And we'll come back in a moment and wrap up with a few of the other stats and similarities and differences in a moment. This is AM 1220 KDOW, the Wall Street Business Network. I'm Tom K. Wilson with the Wednesday edition of Real Estate 360, focusing on real estate investing. Stay with us, and we'll be back in just a minute.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Thank you. Welcome back. We have time for one more question. Daniel, what is it?
Elaine White from Palo Alto asks, what are the advantages of investing in Dallas, Texas?
The advantages I find are that it's got one of the highest rent ratios for a major economic center in the country. It's very business friendly. It's a business capital of the South. It is centrally located, so businesses like that. It's in a Sun Belt, rarely gets shut down for transportation. And remember, it's not just U.S., but Canada, Mexico, South America, all are close in time zone. You'd say, well, in this day and age of world economies, what difference does it make? Well, you still got to ship stuff to people. You still like to talk to people periodically, get emails, responses. If you aren't too many time zones away, operations are more efficient. Dallas-Fort Worth is one of the fastest growing populations in the country. From a risk standpoint, it dropped the least of any metro in the United States. If you look at Case-Shiller, go look at the 20 cities that they track, you'll see that DFW dropped 7.7%. Las Vegas dropped 58%. These aren't medians, which are even greater than that. These are actually same house sales. So it really survived very, very well and protected the downside and protected assets for people very much. We have a lot of Fortune 500 companies in DFW. We have a lot of growth. It's not overbuilt. It wasn't overbuilt before the crash, and now it is even. It's being cautious and building up now. The demand is higher. It's a great place to do business. The occupancy is running 99% down there in DFW, and I expect it to stay pretty high for quite some time. So that's some of the summary of it. Daniel, thanks for doing all that great collection of questions from our listeners. Thank you, listeners, for sending them in. Please keep doing that. Remember, if you go to TomWilsonProperties.com, you can sign up for a weekly newsletter on the economics as it applies to real estate, written by our economist on our team, our associate, Howard Blum, who does a great job of giving you a 2-minute synopsis each week of what's going on. We also have a report on how to select the best metro and product. We always welcome your questions. We're always are glad to do a consultation with you and assist you in your decisions and what you're going to invest in and where and how, and ask questions like these listeners and these folks have asked. We always welcome those your questions, and they're just really, really great ones. That's what I love. People asking these questions obviously have given it good thought. They may not have a lot of experience in real estate itself, but they've given it thought. They're asking very good quality questions, ones that deserve to be asked. We're very proud on our website of being very transparent. When we set up the business, it's one thing I wanted to really do is make sure that people got as much information as they could right at the beginning without having to make calls and multiple calls to find things out. We are very proud of the quality of the products that we have. And we love talking to you. We love helping people start in this business. As you can tell, we're very passionate about it. We have our own skin in the game. I still have a lot of properties where I talk about. So come with us next week. And remember, the only thing that matters is what you do next.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.